Hello, everybody. Let's take a look at the US dollar. Today, we're going to take a look at the US dollar with a fully unbiased, non discretionary approach. We're not talking about bricks. We're not talking about geopolitics. We're talking about what this chart says based on this very effective approach using moving average channel and divergence. Okay, so right over here on the left, we're going to start with a 3 month, and then we're going to find our way down to the monthly and the weekly. So starting with a 3 month, I have the moving average channel here, which is the 10 of the high, which is the thick line, and then we have the 8 of the low. Okay, so we're not using moving averages of the close here. We're using it of the high and the low and that relationship between the two. Down here, we have the Williams Accumulation Distribution Index, which is the colored line. And then this is the 57 period moving average of that index, of that oscillator. Okay, so the rule of this strategy is if you have two candle closes above the moving average channel and the Williams Accumulation Distribution Index is above its 57 period moving average, this market is bullish, especially if it trades into the low of the moving average channel. So what do we see here? We see that the price on the quarterly chart traded into the 8 period moving average of the low of the quarterly chart. And we also see the Williams Accumulation Distribution Index is still well above its 57 period moving average. What this tells me is if we trade into this level is an area we should be okay to look for longs based on the weekly chart using divergence as our first entry trigger. Okay, now this strategy is taught by, this is an evolution of a strategy taught by Jake Bernstein. Jake Bernstein would simply buy this moving average channel with a stop with the same equal to the width of the moving average channel and the target being the high of the moving average channel. That to me has never done it for me. That's not good enough risk reward. So I zoom in onto an entry time frame and utilize divergence as one entry trigger to get me involved. So what we see has happened on the US dollar is there's actually been a divergence trigger. So you'll see price diverged from this momentum oscillator. We can see last week on the close of the candle last week, this divergence confirmed. So divergence is confirmed in the case of bullish divergence. The highest high that the oscillator made during the period of the divergence, we have to see the oscillator close beyond that level, which is what happened last week. So this divergence is confirmed. So what does that imply? That implies that a few things. First of all, we have the divergence targets themselves are basically half of the range that was formed during the divergence on the entry time frame and then the full range. So those are the basic divergence targets, but bigger target would imply a move up to 107,263, okay, which is right up here. That is a huge move. I'm not necessarily super confident that that will happen, but the fact that we have triggered on the weekly with the divergence, that's one of three of my entry techniques, which qualifies for basically a trend change on the weekly. So that is possible, entirely possible, that this trades up to here. Basically what I'm saying is despite all the doom and gloom and negative press surrounding the US dollar, it is quite possible that the US dollar is something you should be more bullish on than the media would have you believe, and the general Twitter sentiment would have lead you to believe. Okay, so now let's switch down to the monthly. We're going to switch our entry time frame down to the daily. What do we see here? So again, remember the rules of this strategy. 2 consecutive closes above the high of the MAC, and then the Williams Accumulation Distribution Index needs to stay above its 57 period moving average. So we can see the last signal we had was a buy signal. We have not had 2 consecutive closes below the low of the MAC. So basically we haven't had a sell trigger yet. So what we have here is what Jake Bernstein taught as the CMC, Cuban Missile Crisis trade. So when you have a full range bar close below the MAC, Jake Bernstein would just buy this and the target would be the high of the MAC on the monthly. So the more conservative target, like we just talked about the quarterly target being quite high, the more conservative target for the dollar is for it to trade up to 104,627, which is the high of the monthly MAC. And we can see that we actually got triggered into this on the daily as well. So here's the daily divergence. And then we had this high of that divergence on the momentum oscillator closed beyond right here. So we would have got long right here and stopped below low and basically riding the wave right now. And we've had every other one of our entry triggers triggered. We had the 18 period moving average high triggered right here. Then we also had 2 full closes above the MAC and the weekly, the Williams accumulation distribution above its 57 period moving average. So all 3 of my trend changes have confirmed here. We are in a definite uptrend, and I think realistically the US dollar appears like it's on its way up to 104,627. At least that's what I'm looking for. Okay, now what about on the weekly? If you're more of a day trader or somebody that trades shorter time frames, this chart is still bearish on the weekly. We're in a bearish trend. We've had 2 consecutive closes below the low of the MAC and the Williams accumulation distribution index below its 57 period moving average. So theoretically, this market is to sell up here, and we've actually had a sell trigger on the 6-hour chart. So we had divergence bearish here, which confirmed on this candle close. Sorry about that, which confirmed on this candle close here. So we theoretically should see a pullback on the US dollar, and that pullback could go quite deep, down to around 100. Now, that doesn't have to happen. Next week, this MAC on the low is going to come up a little bit. So it's not going to be quite down at 104.55. But basically, if you trade the weekly time frame, then yeah, you could definitely expect the market to pull back here this week. However, overall, based on the fact that we've had weekly and daily divergence triggers, supported by the quarterly and the monthly moving average channel, I would suggest and think that the US dollar has some more upside ahead. And the minimum target for me for US dollar is likely up to 104,627. And commitment of traders this week, we saw that the commercials actually continued to add to their longs. They got more long again as of the reporting date there on Tuesday. So a couple weeks ago, the dollar was set up for longs, which I posted on my channel looking for longs on the US dollar, short the yen, short the Aussie, short the CAD, short the euro, and which have all played out quite nicely. But to summarize, I think this move does have more room to go. Does not mean it's not going to pull back along the way, which could be very well on the cards here coming up next week, possibly. I read on Twitter that the US dollar had a record-setting number of consecutive green days in a row. Not a record setting, but the largest number of win streak since I think 2016. It hasn't seen that many green days in a row. So definitely due for a pullback, which I think is coming. But overall, based on this, I think there's reasons to take, there are good reasons to be long the US dollar here and there, which is what happened a couple weeks ago, and it does have some more upside. So if you have questions about any of this stuff I've talked about here, particularly utilizing the moving average channel, you can feel free to reach out to me. And if you like this video, please like, subscribe, and share my channel. And I hope you guys have a great rest of your weekend, and good luck and good trading next week.